Workplace Banking and Member Plus program. So it is a great pleasure to have AMSC as our corporate partners and roll this program to all members. Now I'm going to walk you through what is Member Plus, what's in it for you, and how to access it. So Member Plus is a benefit program packed with a range of unique offers, product discount, financial literacy, community, and networking opportunities. So we bring the beyond banking value proposition to our corporate partners. The program is essentially supported by 3 key pillars. The first pillar is a range of benefit and discount that cover your everyday banking, credit card, home loan, insurance, and discount foreign exchange rates. The second pillar is financial literacy. We facilitate a range of financial literacy sessions on various topics, help you to build financial confidence and make informed decisions. The third pillar is beyond banking and networking opportunities. And on this front, I'll walk you through in further details in the next few slides. So here I would like to introduce what is the current offer right now. So if you do the refinance, bring your home loan to Westpac, you will receive a $4,000 cashback. And if you apply a new loan, you will receive $1,000 cashback, plus a waiver of the package fee for the first year, which is a saving of $395. So this offer is only available for those members of AMSC, who is our corporate partners. So in terms of financial literacy session or webinar like we are doing tonight, so we build the material around customers' life cycle. In the early years, as you may start out your financial journey, you're increasing your income and assets with your first job. For instance, buying a car. And after a few years of working, you move to the next stage of your financial journey where you are building and optimizing your wealth. You may think of owning your first home. So we have material like managing your home loans to get ahead, buying your first home, relocate or renovate. And some years down the track, you may move to the next stage of life, which could be getting married, growing a family, and building and maximizing your wealth. So we have materials like investing, buying an investment property, or show you how to measure the return on your investment property. Last but not least, retirement planning. So as this is what is going to sustain you after you stop working. It is never too early to think and plan for the retirement. And we have material like planning for your finance for retirement, managing your super, or a guide to self-managed super funds. So on the third key pillar of the program is about community and networking. So we invite our partner to exclusive events as economic updates with our chief economist, Bill Evans, or co-host the event with third party on the topics that are of interest to most of our customers. For example, we ran an event with CoreLogic on property market, talk about housing trends. Another example is Ruby Connection, which is an interactive online community with a key focus on women's development. It is designed to inspire, educate, connect, and support women. Once a month, there's a session on women's specific topics, such as gender pay gap, mental health, or domestic violence, etc. And another piece is the Westpac Wire, which is a hub for news, insight, idea, and opinions around finance and economy with a good dose of other societal topics that Australians are interested in. So as a partner, as a member of our partners, they always receive invites to attend all these events. And hopefully we can do this face-to-face in a very near future. Now I'm going to show you how to access all these benefits. So as our corporate partner, you will have the access to our microsite where you can find all the benefits and supports that you need. Unique access code will be provided to our partners. So this code you can find out if you're the member of AMSC, then you will find this code out in the communication that AMSC sent to you. So in the microsite, you can, once you enter the code into the microsite, you can find all the products that is available on the top left corner of the website. That includes everyday banking, home loan, or personal loan. And if you want to find out what are the current offers, you can always click latest offers in the middle of the page. And that will bring you to another page. Hang on. No. Okay, so that will bring you to this page to show you where the current offers are. So here you can find the $4,000 on refinance that I just mentioned. And here's a range of the current offer. Other than the refinance $4,000 cashback, you have $1,000 cashback on new purchase, plus a waive of the package fee of $395 for the first year, zero establishment fee if you got a personal loan from us, and also enjoy discount on foreign exchange rates, and a waive of the account keeping fee for this 12 months if you have a choice account with us. So how to get in touch with us? There are several ways that you can go to the website I just showed you. So you just click inquire now, then you can fill out a digital form that we will have the expertise to call you back. And other than that, there's the 1-300 numbers that you can contact us during the weekdays, or there's an email that you can send, and then we will get back to you to help you with your banking needs, or just visit a branch and talk to our banker. And the entire program is supported by a team of dedicated banking professionals. And tonight you will have James Yao, who we introduced earlier, he's the executive home finance manager, together with Sam Ma. They work in the same team. Both of them are really experienced in home finance. So this pretty much everything I would like to communicate with you about this program. Any questions? So if you don't have any question at this point, that is fine. And I would like to hand over to James and Sam and start talking the topic, buying an investment property. Thank you.
Hey, James, can you go ahead first?
Yep, no problems at all. So thank you so much for the introduction, and it's definitely a privilege to be able to speaking with you guys today. Obviously, we've done our introductions. My name is James Yao, and obviously my team leader is Sam Ma, who's one of the most experienced home finance managers in the industry, and also within Westpac. So once again, thank you for the privilege today. Our purpose today is just to give you an insight as to the things that we do on a day-to-day basis, how we help out our clients on a day-to-day basis with their financial needs and their financial goals. And the purpose of tonight's session is just to give you a basic understanding of the things that we can provide and the ideas that we like to present to our customers to help them with their financial needs through their property journey. So what I will do is I'm going to be sharing my screen in regards to a presentation on investment buying. So buying an investment property is something that generally runs through everybody's minds throughout their period of their life. I would never say that it's too early to look at buying an investment property. Neither would I say that it's too late to buy an investment property. There's specific times throughout a person's life stage that you can consider the purchase of investment properties, or even expanding your investment portfolio, regardless of which avenue you want to look down. So as you know, with investments, there's a lot of different ways that you can be using your money to do investments. So you've got the share market. More recently, you've got Bitcoins and cryptocurrency. There's also other avenues of investments that you can potentially look at. So during the market segment that we're looking at the moment, a lot of people are focusing on investment properties. And the reason for that is investment properties are generally more tangible assets. Assets that you can see, assets that you can feel, is assets that you can purchase and have a comfort in knowing that it is not something that's going to rise very, very quickly, or it won't drop very, very quickly. And having that sort of safeguard and that sort of backing behind it makes it a popular choice for investors alike, to know that when they're putting something, putting their life savings into an investment property, that it's something they will get a return from sooner or later on down the track. Now, during this presentation, I just wanted to give you some ideas as to how you can consider an investment property, the purposes of buying an investment property, and ultimately the reason of why we buy an investment property. So a couple of things I will be looking at today is, number one, the investment strategy. So how do we plan looking at buying an investment property? We want to know the purpose of buying an investment property, and how do we maintain this investment property to the point where it delivers us the success that we're expecting from the money that we're financing into it. The second part of the presentation will be discussing the financial aspect of things. So this is where your banker, so myself and also Sam, may come into the equation, where we can discuss the finances of supporting you in buying your investment purchase and take you through that journey, so we make it as simple and easy as possible, as well as ongoing management of your investment property as well. So I'll be discussing the first part, which is the investment strategy, and then I'll hand over to my team leader, Sam, who will be discussing the finances and ongoing management. And then after that, we'll be taking some Q&A sessions for any questions that you may have. And it does not necessarily have to be about investment properties. It doesn't have to be ultimately just home finance. We can also talk about your banking, the way that you conduct your business at the moment. So happy to go through that at the end as well. So when we're looking at investment property strategies, I'm sure a lot of you have already heard about stories where people have put a lot of money into an investment that they believe and hope will be bringing in either revenue or bring them capital gains. But a lot of the times when we're not sort of doing our research behind the investment portfolio that we're trying to build, we could lead to instances where the portfolio does not actually expand, or it's not heading in the right direction that we're aiming for. And in the worst case scenario, where we can see that the portfolio has actually gone backwards, which is something that we really want to avoid. I'm not saying that it's something that is definitely unavoidable, simply because there's a lot of factors behind it. For example, the market conditions, the economy, the location that you're buying, and things like that that are out of our control, such as the pandemic that you can see at the moment, where a lot of people have gone backwards on their investments, but at the same time, a lot of people have made a lot of money off their investments, and that's sort of the goal that we want to go by. So irrespective of whether we're in a good climate or a bad climate, we're putting our money in a place that is ultimately going to be growing our finances and growing our portfolio at a steady rate. So there's a case study that's on your screen at the moment where Wendy and Declan have thought, look, why not buy this property that's come up for sale next door? Now, potentially they haven't done much research. They've seen this property, they've liked the property, they live in the area. So they're thinking that this might be a good opportunity for them to embark on their investment journey. So what happened was, last month, they sold the property for a small amount of 2% capital gain. And then on top of that, during the year, it was untenanted for 6 weeks. So not only did they not experience the capital gain that they were after, they also had a period of time where there was no income coming in from that property, meaning that they could potentially have been paying for the mortgage themselves, which is not something that would be the ideal situation. Knowing this, they really want to get an understanding of what's the best way to approach the investment side of things for property. And this is where we want to discuss a few hints and tips as to what you can do to make that next purchase a lot more safer and a lot more consistent. So the first step is to actually consider your investment strategy. So what is the reason you want to buy an investment property, and what are you trying to get out of it? So generally speaking, there is two reasons why you can look at buying an investment property. I will come up with a third reason as to why as well on the back of this slide. So number one, a lot of people look for growth. So a lot of people out there, they would like to buy an investment property in a certain place that they deem will have the best growth. Now, when you were saying growth, we're looking at the property price increase over a certain period of time. Looking at things like this, we're looking at how's the development around the area, the infrastructure the government's putting in, the type of lifestyles people like to live, etc., etc. The other side, the other flip side of it is actually the monetary money that's consistently coming through the door from the rental income that we're getting from the investment portfolio. Or ultimately, it could be a combination of both, where we're saying, look, we want to be buying an investment property that's going to give us strong growth, but at the same time, it's got enough income coming in to fund our finance behind it as well. So we don't have to be putting our money in continuously owning this property. Now, the third thing that I wanted to add was looking at the potential of financial freedom. So yes, capital growth is important, and that can ultimately bring us money later on down the track if we decide to sell. And also rental income coming in can fund our finances. But we can also look at a proposition of what if we were to buy a property that is going to grow up in value, but is also going to bring back income for us. And as a combination, it could generate us, could bring us to a situation where later on down the track, we might have 1, 2, 3, or multiple investment properties that are possibly paid off or not have too much finance behind it, and it's generating us positive income, which could help us fund our retirement later on down the track. So there's two types of wording that gets thrown around fairly often when it comes to investment purchasing. And this comes down to when you do your taxes. So you're looking at positive and also negative gearing. Now there's benefits to both sides, so I'll go through the details of both of them just to give you an idea as to what they can actually do. So number one is what we generally hear is negative gearing. So this is when the expenses on your property are greater than the income that you receive from the property. I know that sounds a little bit weird in saying that, look, I'm putting some money into an investment, but it's going to cost me more than the money it's going to make me. Understandable. So what happens in that situation is, from a tax point of view, your accountant would look at your investment property, have a look at all the expenses on it. So this could be the interest that you're paying on your home loan. This could be any maintenance that you're paying. This could be the agent fees that you're paying to the real estate agent in managing your property. And also it could look at the depreciation of the property itself. And when they do the tax claim, it becomes a negative gearing side of things, which means that it's costing you to actually fund the property, and therefore it can be a tax deduction for your tax return, bringing down your taxable income and bringing back some of the tax that you're paying throughout the year. So that's sort of the positive behind negative gearing. The next part of it is positive gearing. So this is very simply the flip side of negative gearing. This is when the income that is coming in far outweighs the expenses on the property. Again, there's positives and negatives to this. So obviously the negative side of things is because you're positively geared, we're adding more income onto your taxable income. But on the flip side, because there's more income coming in than your expenses, then your property could potentially be paying itself off. So there's no intervention from yourself from a monetary point of view, and you're having a property that's going to be paying itself off over a period of time. So capital growth. The idea behind capital growth is we're looking to buy a property in a certain market for a certain price. By holding on to it for a period of time, we're hoping that property goes up in value to a certain extent where if we do sell that property, we are going to be making a profit off of it. A lot of the times what you can see from people that don't do too much research about the property that they buy, they've bought a property for, as an example here, bought a property for $400,000 with the hopes of selling it for potentially $480,000 later on down the track. But the reality, and as with the case study that we've seen before, they purchased a property for $400,000 and ultimately sold the property for $408,000. So not as much growth as they would have wanted in the beginning. Now, there are a couple of different drivers of growth, and this is growth in property value. These are not all of them. These are just some of the key pointers that get presented to people when they're buying a property. Number one is population growth. So this is what you're looking at, demand versus stock. So when you're looking at population growth, obviously places that are heavily populated may see more demand for the properties that you're looking at buying, which could drive up the property value as well. Also, neighborhood demographics, who you're living next to, what sort of industries are they working in, what sort of background are they coming from. And when I say background, I don't generally mean ethnicity. I'm looking at, are they more families that are living there? Are they young professionals that are living there? Are they retirees that are living there? So that can also play a factor into it as well. Proximity to public transport and amenities does play a big part of it as well, because people like to have the convenience of having transportation that's available to them, and also shopping centers and recreational facilities available as well. Future plans for local development. So this is what the government is going to be injecting into the local area, and which follows on with major projects and infrastructures. So let's say, for example, if they're going to be building a rail line over there, if they're going to be building a tram line, new shopping centers, new developments for childcare facilities and things like that of that nature, that can also grow, help grow the market as well. Now, one item that I like to use with my customers is actually historical trends. So how this is generated is you've got many different avenues that you can look at. So realestate.com does provide something that will give you an idea of specific suburbs and specific properties within the area that you're looking, and seeing at over a period of a year, period over a month, period over a 10-year time span, what does the trend of the property market look like there? Now, the purpose of this is so you can get an understanding of that area and what's been happening with the property historically. Obviously, if you're looking at a property within an area and the property trend has always been going down and it hasn't really seen the way up, that could be potential to say, maybe that's not the right property for me. But at the same time, you can also consider it as, if it's on its way down, it might potentially go up. And that's where the previous slide and all the things that you can consider, you can look at and seeing that if you're going to be buying at a low price and then selling at a high price later on down the track. Also looking at this, you might see a property market that is going upwards in trend, or potentially going down and then up and then down and then up. What we'd like to see is a property trend that overall, the effect is a linear progression towards the upward scale. And that's where we want to be investing our money, because we can see that the prices have been going up historically. Now, there's an aspect of rental yield that we can also look at. What rental yield is, very simply, we want to see how much return are we getting for our dollar that we have invested into the property. So in layman's terms, what's the best bang for buck that we're getting from our investment? So the easiest way to calculate this, and a lot of times real estate agents do actually provide this for you when you're buying an investment property, is they look at the rents less the expenses that are involved with a particular purchase, and then you look at the yield that is available from there. So they might say to you, you might see a percentage. So the rental income holds a 5% yield, or a 3.8% yield, or a 9% yield, something along the lines of that. Obviously, needless to say, the higher the percentage, the more that you're getting for the investment that you're putting in. The very easy way to calculate yield, as you can see with the calculation on your screen, is simply rent per year, which is your weekly rent, multiplied by 52 weeks, divided by the purchase price, multiplied by 100. So if we take the above scenario where the property is rented out for $400 a week, and it's been rented out for 52 weeks, then that gives us a rental income of $20,800. Divided by the purchase price of $400,000, multiplied by 100, gives us a 5.2% rental yield. And that is a very healthy rental yield in the market that we have today. So if you're getting something like 1 or 2% rental yield, then maybe you would need to consider whether that property is going to help you with capital growth as opposed to rental yield. If you have a high rental yield, then it could be just positive cash flow that's coming in, but it could be in turn that the property may not go up in value as quickly as possible. The best example of this, with a property that's a house on established land, so an individual house, you probably see that the capital growth is a lot better than the rental yield that it provides. And on the flip side, it would be an apartment or a unit where the capital growth is a little bit slower, but the rental yield is a lot more. So it's something that we can balance out and see which one do we prefer to go for, or are we looking at a combination of both? And then that's the figures that we can use to determine our decision at the end of the day. Managing risk, there's a couple of things that we can also look at to manage the risk of our investment. So we look at population decline. Are people moving out of the suburb more than people are moving into the suburb? The neighborhood demographics, once again, the lack of access to transport and also amenities, the type of tenants that you're going to be attracting in that market, no future plans for local development, decline in projects and infrastructure, and vacant property, which is no tenants. So pretty much the opposite to what we're looking for when we try and do research for an investment property. So there's a lot of important market indicators that we want to look at: GDP, unemployment, job growth, movement in interest rates, and also inflation. So as you can see by the graph there, prices peak, prices soften, prices trough, prices rise. So there is that sort of momentum that it can go through, but our research will help us determine when is the best time to buy and where is the best to buy. So I know I've gone through a lot here today, and those are some of the tips that I would suggest to my customers when it comes to purchasing investment property. By no means is that all the things that you should be looking at, and there's a lot more things that you can consider as well. And one of the key aspects to buying an investment portfolio property or building an investment portfolio is having your finances ready. So this is the funding of the purchase. And what I'll do now is I'll hand over to my team leader, Sam, who will discuss the finance aspect of things. Thank you so much for your time.
Hi, thank you, James, for helping me out with this presentation. I hope you guys can see my slides at the moment. If it's not, let me know. Basically, that we talk about finance. I mean, we are the bank, we lend money, but most importantly, that what's the finance going to play in here in helping the customer to actually do their investment, helping you guys to prospect your wealth. Basically, this is a section where can be a very simple section and can be very, very complicated section. The simple section of it, if you look at my next slide, is Nick has wanted to have the purchase in the investment property, and he's got this too risky and think about it, whether it's too expensive, until he talked to an expert. The expert being me in terms of finance, or real estate agent in terms of the property that he can locate it. Now, the example here, it looks like the purchase price is 540. It's got a saving equity 130, and that's straight away from people who actually got experience in the lending will know that this could be the deal in terms of a cash as a contribution and borrowing as the way to actually go through. And then before we actually diagnose whether their income or their financial situation in the background sufficient to service the loan that we're going to take. I think the thing we didn't know much is that a person's financial model could be different. If you look at this one here, we have a primary inflow of the finance that you actually can earn the income. You got income from different sources like your other rental income, helping from families, overseas income, all sorts of incomes. The deposits where you actually having quite a bit of other yields. If you go to you got to have outflows. So how you're going to spend the money, when you're going to, where you're going to spend for. Then you can see on this slide here. You can spend it now, spend it later. You can give it, or you can grow it. Spend it now means that you got to enjoy yourself. You spend the money to your recreation, your gym, a basic necessity, or you spend the money to buying a luxurious car. That's you spend the saving that you have. Or you spend it later. You're saving some of the money, but you do some planning. This is what we do because you need to spend it later on for a trip, a major trip, all this stuff. Also a necessity. But spending on something else, like if you can actually, give the money, you put it to a donation, or you save it for your kids for their next property, all this stuff, or you grow it. Now we're more focused about growing it. How are you going to grow it? Put the money into the bank, put the money to the Bitcoin, or you put the money to other area like properties. It's one of the ways that you think about it. Yeah, usually people try to do the grow. When you do the growth, it's about investment. Now, it's more about what kind of investment you're doing and what the return it is. Now, so growing will actually make yourself to have a second inflow by means of return from the yield, like James just mentioned, or return from the sale of the capital gains later on. So if you actually decided where you want to buy a house, how are you going to make it happen? So basically, you need to save the money. You have to have the 20% rule, 20%, 80% rule. I mean, I'm talking about usually, but majority of you guys in medical industry, some of you guys might entitled to only using 10%. I'll actually demonstrate what's the difference between 20% or 10% in a minute. But for now, usually you need to actually come up with the cost for the transaction, which is 20% of your of the deposit you need to pay, plus the stamp duty that you need to consider. If you're actually the first-time buyer buying something to live in, different state might have different way to concession or cash pool, whatever it is. Like for instance, in New South Wales, 650, anything under 650, and you're buying that for the first time, you don't pay stamp duty, but you need to always budget that. So what is that involved? But usually it's 4% or 4.5%. So the cases like here, so you got an upfront cost of 22, maybe already including the solicitor cost or other costs, and the property value is 540, total cost is 560, right? So if you actually go for this, property is 540, we're lending 80% of it. We don't lend anything on top of the property value. So basically we only lend 80% of the property value. And this is the tricky part. We actually, usually the bank only lend either 80% of the purchase price or property valuation. So people actually tend to go to the auction nowadays. And if this is what is happening, you got to really be careful, because if you buy a property for 540, but the bank actually value that only 500, usually we only lend 80% of that 500. So that's the tricky part. So you tend to have a little bit more savings or other way to actually help yourself if there's something, some stage of the transaction have some problem in there. Then you actually go. So if you look at the slide here, you've got 22,000 is upfront, and you got own contribution 130. So you make that happen. And alternative way of that is about equity. Now, when we talk about equity, there's a lot of things. Some people say, well, look, I don't have enough money. I have my house, I have my own occupied property, which I already have the value of 500, but I have 290, which is the loan, and that is whether I got equity. Now, if you look at the slide that I tried to get a little bit higher on there, if you look at the last one that I show you, so the property value is 500. I mean, the one that you are living in, but then you have the lending value of 80%, which is supposed to be 400 that you can lend. Ultimately, you have the existing loan of 290. That would mean that you got an equity of 110. So equity is more about 80% of the remaining value of your property after the exclusive of the loan. So you got a property of 500, you got a loan of 290, doesn't mean that you have the equity of 500 minus 290. The equity is only about 80% of 500 minus, minus whatever the loan. So it'd be different things in there. So if you actually look at the 110 here, you will see that on the left, if you go for 80%, you need a deposit of 108. That's we call 80% in the purchase. And what's this equity for? The equity would not be used in this case for the purchase of the property on your left, because you got sufficient, you got 80%, you got 20% already. But if you go to the next slide, So this last slide here is that if you only got 54,000 of the deposit, then you either would consider using the equity of the slide that I mentioned. So you use the equity of that property, using two properties as security, lend you the money you want to avoid the mortgage insurance. But if you don't, so that's what we call equity. Now the other equity side that you can consider is what we call a guarantor, which we are not actually showing in this on this slide, but I can go through a little bit with you to avoid the mortgage insurance. So basically, if you go back to here, so if you actually don't have enough equity on your own property, but you still want to buy something, and you don't have 20%, you can also use the guarantor option, provided your parents, your brothers, or your sisters who have property, have equity in there, they are happy to actually help you out. Then pretty much they can be joining as a guarantor to your loan. I mean the guarantor in terms of the equity only, not the income guarantor, so that they can help you to actually cover for this 20% mark to make it happen. Now in Westpac, we are not only doing the guarantor for the first mortgage, we also do a guarantor for a second mortgage. So that would mean that if your dad actually got a property unencumbered, there's no mortgage, we give the bank as a guarantor, that's first mortgage. But your dad already got a property, but they got a loan in another bank, let's say ANZ, but you want to borrow in Westpac, but you don't have enough savings, then you can consider to have equity of your dad. If he's happy, then Westpac are happy to take second mortgage on the property that is sitting in ANZ. So he doesn't have to move over. That's the beauty about the guarantor bit of it. Now, after this one, we need to actually talk about lender mortgage insurance. Why we need that? We need that if you don't have 20%, but you want to borrow more than 20%, more than 80%, or you don't have other people to help you to provide the equity as a guarantor, but you still want to buy that. Let's say you only got 15%, and you want to buy a property, you want to borrow 85%. Then the bank will actually consider whether we're going to do that for you, right? If we are to do it for you, pretty much you need to pay mortgage insurance. So that's what the mortgage insurance is more about. The mortgage insurance is not actually covering you. It's pretty much covering the bank in case you have any issue. So bank actually get the insurance from the third party. And if you actually default the loan, the bank have to recoup it. If the bank could recoup it from you, but if you actually, your property sale wouldn't be able to pay back the bank full money, the bank actually can turn to the insurance company to get the money back. So that's what we call the mortgage insurance. So you pay the bank to protect the bank. That's more about the story. So basically, but usually this is only one-off and only on the settlement, and that's it. So mortgage insurance, it depends on the banks. There's a lot of criteria about the mortgage insurance. For instance, you need to show that you have 5% genuine savings. If you borrow over 85%, I think this is a little bit more technical now, which we can go through more individual case if you want to ask me. Another thing that come in with it is also like percentage the mortgage insurance change depends on the percentage borrowing you want. At the moment for investment property, we can only do mortgage insurance loan up to 90%, inclusive of mortgage insurance. But for owner-occupied, we can do up to 95%. Now, bear in mind some special industry area, professionals, we waive that mortgage insurance up to the 90%. For instance, if the doctor and a specialist, we actually lend up to 90% without needing them to pay mortgage insurance on that. And in fact, we actually can lend up to 7.5 million on the medical side for for doctors, where if they want to buy a property, we can lend up to 7.5 without questioning as to whether we can really lend you 80% or 85%. So that's a bit different on the mortgage insurance, but it's more technical now. But all these things that we can be answered case by case. Now, so I guess I already get through this, but if you want to go to this a case study, so if you've got a deposit 102, you got a transaction cost 20, the loans 432, the purchase price is 540. So that's how it is. Now, what's the upfront cost? Upfront cost is more about the stamp duty, registration fee, conveyancing fee, property inspection, borrowing costs. Now, of all these, when you go for a lending, don't worry about the 1, 2, 3, 4 at the bottom. Just look at the stamp duty and tax first. Stamp duty is the major things. My job is to, if you actually want to borrow, my job is to make sure you have sufficient funds to do the transaction. So not only just the 20% we mentioned or the 5% we mentioned, mortgage insurance, whatever, I always have to counter your stamp duty. Not much you will have the registration fee. In fact, in Australia, I mean, in Sydney, we only 100, I think it's only 197 for the mortgage registration fee. Conveyancing fee varies. It depends on who you actually fund to. Simple transaction like the residential house, you don't really need to have a very, very, expensive lawyer. You probably just need a conveyancer. They're charging ranging about 1,000 to 2,000, or some people 3,000, but very more reasonably $1,000 to $2,000. Property inspection, couple $100. Borrowing costs. Now, borrowing costs is almost minimum, or almost zero now. There's a lot of competition between the banks. There's a lot of bank want to actually offer to the customer. So borrowing cost is not that much as upfront. Borrowing cost is ongoing later on when you pay the interest. So when you actually go for the cost, my recommendation is don't even look at the bottom. Just look at the stamp duty. That's what you need to do. Okay. Now, the next thing is that we talk about the annual expenses. I think this is a little bit more about what James just discussed already. More about the annual interest cost, property management fee. This is the actual cost. Annual return. So you got the rental return. You got the tax impact. Now, well, that's where you do the tax. Then you overall how much you earn or whether you lost or not. But from cash flow perspective, I would suggest you actually ignore the last bit, which is tax impact, because this tax impact is more about the tax time. There's a bit of what we call the upfront, getting a tax refund. But I don't normally encourage our customer to look at this part. I'm more about the top one. So how much you spend this year and how much your rent actually come in, well, that's the cash flow you come up with. Don't worry about the tax refund. That's the bonus for you to actually go out for dinner, I would say. So out of the pocket expenses, so this is what the formula. So weekly, you're actually only spending $73. And again, I don't believe in it because $73 is more about a actual return that you are spending. But in terms of cash flow, I'm more about cash flow. If you talk about the cash flow, it's more about how much you spend more. Apparently, you spend more than $73 on the monthly basis because the tax refund is only come after the tax done. So now we go to this ongoing management. I mean, I think this is more continuing about the investment properties side. So ongoing consideration about it is that tenant selection. I think James actually mentioned, and we actually related to this. Well, what kind of tenants you have, whether you actually choose these tenants, maintenance, now what strata fee they actually have, in the rent correction, whether you actually correct through the agent or you just do manage yourself, all this stuff. So how to deal with the vacancies, whether you should have a long-term lease or short-term lease. I think this is more about the real estate agent's suggestion as compared to my suggestion. But basically, we try to actually let you understand this is all something you need to actually consider or look at. Now, what tenants' right is, whether they should have a insurance, whether you guys actually should buy a what we call a landlord protection on it to protect yourself. This is something that you always have to consider. Now, whether you actually do the manage the property under yourself or under the property manager. If you guys are very busy, I think manager is the best. Otherwise, self-managed is a good thing because self-managed actually give you a lot of benefit of saving the money, getting more close with the tenant. but you also got an issue. If the tenant's got an issue, it's going to be difficult for you to deal with it, because if you have somebody represent you, it's a lot easier. So I guess these things we can always go more into there, but I believe you guys can digest as to there's always a pros and cons in choosing whether we need to use the agent or whether we actually use ourselves to do that. Yeah. So we pretty much come to this end. So we're going through investment, property strategy, the finance, ongoing management. I mean, this is a basic, scenario. It could be more complicated. Unfortunately, that I guess this is the first part of the presentation for you guys. And I thought we actually give a little bit of base information to you, because I believe that a lot of people have a lot of experience already, but we still have to counter for some people who probably new, and we try to actually not just selling the finance. It's more about getting you guys to a bit of understanding first. But we're certainly going to have another meeting later on to make sure that we can actually demonstrate other way to help you out with your finance later on. So if you guys have any question now, I believe that we are ready to hear to answer you, both James and me.
Can everybody hear me?
Yeah. Of course.
Okay.
Oh,
all right. So, sorry, Seng Chua is my name. I've seen a lot of. I'm glad to see a lot of familiar faces in the meeting rooms. Look, firstly, I just need to declare my potential, my conflict of interest being the chair of the board of AMSC. However, I thought I want to make 2 points. The one point is this is a personal testimonial. This is before AMSC become a corporate partner with Westpac Bank. And one of the reasons we actually choose Westpac, and in particular this particular investment arm, it's because we have been actually looking around and searching for the right things for healthcare professionals, especially doctors, nurses who are actually needing finance and find it is hard to go through all the paperwork and not having reliable people to work through it. And we find that through experience, even my personal experience, that this team amongst all the team that we know are actually very efficient. And I can talk to you guys, any particular person offline, about the experience that this team have before and how competitive they are. So firstly, with my personal experience, I managed to refinance my property through SAM, and I donate half of the proceed to another organization, and we're talking about more than 5 digits in terms of the refinance and the kickback that Westpac can give us, and half of it actually go to a charitable, and Westpac is very good at doing that. And the other thing, of course, for all of us during healthcare professional, where we really don't want the fuss of the paperwork of doing all this, I find this team very good. They actually come to my home and get everything done. The last thing I want to, being not a computer literate, is to know how to go through all those things, and they can fix it for me, even during weekends and all those time. I think that's important. And as the other thing that Sam was talking about, AMSC will aim to have more, because as medical professional, as healthcare professional, we have different stage of our career and investment. We'll be inviting them to talk about other aspects such as business investment, property investment, and all these things. And this is just the beginning for the basic home residential investment. But by all means, join us. AMSC's subscription fees is $90 per year, and you can tell from just simple calculation, if you need to finance And if you need good services, I think Westpac, this team of Westpac, I can't tell you about anybody else. This team of Westpac, I'm quite confident with them.
Okay, thanks, Sam, and thanks, Sing, and thanks to the Westpac team. We do have a few questions in the chat room, and just for everyone's benefit, I'll just read them out to you. So is the general advice to buy a first home or investment property first?
Well, it all depends. I think, sorry, James, it all depends on the person's situation, you know. Basically, I would say that it's totally depends on what they used it for. Some people, they wanted to buy something to live in because their situation changed. Then they should actually buy something to live in. I mean, at the end of the day, it's not about all our investment is more about creating wealth, creating a better situation for us, living area for us. So if they actually find something that they need to actually live in immediately and they can afford for it, buying their own occupy, of course. But if they're saying that no, I'm happy to live with my dad, I don't have this desire to immediately doing that, investment option is one I think is the best idea for them, I would say.
Thank you. So the next question is, in any lending that's taken, regardless of what property it's is used as a security. So for investment property, is the interest on it tax deductible?
Yeah, so I was actually answering that question in the chat group. So my understanding is very simple. It comes down to the purpose of the loan that you're taking. So let's say, for example, if you were to buy an investment property and it's going to cost you X amount of money, and then you're using equity from another property or even two properties to fund that purchase, this particular loan, the entire loan is tax deductible. So it doesn't matter if you're taking it from the parents as a guarantor's property, or if you're taking it off your own occupied property, or even investment property for that matter. Because the purpose of the loan is to purchase this investment property, then this interest is tax deductible.
Thank you. And the next question is, does that need to be stated and documented by the bank when the equity mortgage is taken?
So not necessarily. When you buy an investment property and you take out a loan through the bank, we will give you what is called a loan account. What happens is every financial year, the bank will actually send you a statement in saying, for this particular loan account, this is the amount of interest that was actually paid. And that figure is what you take to your accountant and say, this property that I bought at, let's say 123 George Street, Sydney, I used this loan of this loan lending amount, and the interest that I paid was $30,000. Then for this property that you bought at 123 George Street, Sydney, that amount of money is tax deductible. So the only document that you need to provide to your tax accountant at the end of the year is what we call the tax statement or the interest statement.
Perfect. So there's another question. Apparently states, lending to doctors who are usually self-employed is usually very difficult compared to pay-as-you-go. So is Westpac the same as other lenders when it comes to lending obstacles?
I think,
well,
yeah. So I was just going to say, the best way to understand that, and this is just my approach, right? I don't necessarily believe that one way is easier than the other. I don't want to sort of blow this out of proportion, but it really comes down to the experience of the lender that you're dealing with. You might go to a bank with a lender that doesn't have experience in PAYG, or vice versa with self-employed, and you might find it difficult in getting it across the line. But if you find somebody, for example, a Sam Ma, who's very experienced in both departments, then you probably find it's a lot easier to get through. Just to give you an example of a customer that I've been dealing with, the wife is PAYG and the husband is self-employed. They approached ANZ Bank and it took 2.5 weeks and no application was submitted. I took that application from start to finish within 4 hours. So at the end of the day, the easiest way to answer that question is it really depends on the lender that you're dealing with and the experience that you have. Sorry, Sam.
Yeah, definitely. I agree with what James say. I mean, at the end of the day, it's more about the person that you deal with. It's not about the bank, not about Westpac, not about ANZ. You know, it's all about a person. So it is a bit of a complicated documentation. if you're self-employed. However, being a doctor, we pretty much only need 1 year's financials anyway, and particularly that I would say known as Westpac, majority of the bank have changed their policy for self-employed, and the way they actually do it is a bit different to the way they was. But yes, we do need some documents, but it's more about the person who you are with, whether he actually asks you in the proper documentation, whether he actually talked to you in a way where you can accept it, that you are helping, he's helping you out, and you are really wanted to give everything to him. I think it's more about that.
Sure.
So, yeah.
Yeah. Any more questions from our attendees? Everyone's a bit quiet today. I do have a question myself. Is there any difference between lending for just a pure home loan versus a house and land package?
No, actually.
So it's not any more complicated.
Well, the process is a little bit complicated if you're a house and land package, but so that's why you got to be, so not only the lender, but also the customer that we deal with, we need to actually educate them to make sure we work together to make the things smooth. The process is a little bit more complicated in terms of, because there's 2 stages of the things, not just the land, but also the construction, valuation, progress payment. All this is a little bit more complicated, but fundamental is the same. At the end of the day, it's more about your income, your equity, whether it's sufficient to do that. Other than that, everything should be the same.
I might actually ask one question again from my experience, and also to tell the floor. If you are doing your investment or refinancing under a trust, it is a lot more complex. I'm sure Sam can elaborate on that.
Yeah, well, it all depends on what kind of trust it is. Now, if the trust is under the personal name, but very rarely, if the trustee is a personal name, then Westpac can allow doing this loan through a normal residential lending channel. But if the trustee is a company, even the property that the trust hold is a residential property. In Westpac, it's become a business lending area. So it's a bit of a complication because business lending area might really need to have full financials. So even you are PAYG, you still need to actually have your tax returns, things like that. In terms of the complication about that is that Dr. Charles says it's more about the process, the bank with the business lending area, the process is actually slower. I agree with it because we actually got that experience before. But if it's a trust under a personal, being the trustee, or a property is only under personal name, that would be easier, put it that way. But again, whether the property is holding under the trust or under the personal name, as long as it's a residential property, they do enjoy a residential rate. Even the process may be a business lending area.
Sure, we do have a few other questions. The next one is there a maximum loan amount combined from all lenders for one borrower to borrow even if he has plenty of equity?
James?
So with that one, there's no hard limit where we're saying there's a total dollar figure that you can lend up to when it comes to different banks. The easiest way to sort of understand it is equity is giving you the capacity for you to borrow against. So a security value for you to borrow against. Your borrowing capacity is looking at your income, your liabilities, your expenses, and how much of a loan you can afford to service. So let's say, for example, if a customer has equity to the value of $1 million, but based on your income, your liability, and your expenses, your maximum borrowing capacity is $500,000. So we can use up to $500,000 of that $1 million equity to borrow against. Just because you've got a lot of equity does not mean that you can borrow the full amount because your income has to service that. As long as your income is capable of servicing the amount that you're looking to borrow, and you've got sufficient equity through the properties that you own or the property that you're looking at buying, we can borrow up to that amount. So more or less, there's no hard cap on it, but there is a cap based on number one, your equity, and then number two, your borrowing capacity, and it's going to be the lower of both.
Okay, so there's another question which I will simplify because I think it's a bit confusing how it's stated. Does Westpac offer lending to people borrowing to invest in overseas properties?
No, well, look, at the moment, not with the residential or consumer lending area. I think this is more about, it might be the case, it's more corporate area or institutional banking area where they do it in a different way. But we only, well, basically, put it that way. If you got a property, you got equity, and you want to borrow against the property equity, I can lend you money. And you use the money for overseas investment, no dramas. But if you want us to take the charge of an overseas property and lend against on that property, we don't do that.
Okay. And the next question is, using a self-managed super fund for purchasing, what is the lending percentage?
Well, I would say new at the moment. Self-managed super fund used to be one of the big chunks of the business of the banks. But I would say that all the Big Four, and even with the second tier lending, majority of them already stopped self-managed super fund lending. If they already got the lending with us, their grandfather, but basically if they are new lending, pretty much go to third or two or third tier of the lending. I think it's because the government's intervened, and it pretty much is a little bit of the our process. So it's not us, we don't want to do it. It's just that we are not offering this product anymore because of the compliance, all these issues behind.
So I just want to clarify, this would be referring to using the actual super to purchase, not splitting the loan into two, not splitting the investment into two parts. So for example, you're using the super fund for part of the deposit, and then you split the part that's not accounted for into your personal loan. So would you still lend for the personal part of that loan?
Well, if they are, what I would say that if they set up a self-managed super fund and use the self-managed super fund to buy something or buy a house or buy investment property, we don't lend on that for the Big Four at the moment. At least Westpac's not doing, but I'm pretty sure all the Big Four's not doing anyway. So, but in terms of other things, well, I'm not sure how this works, but we do use the self-managed super fund's income to service the loan, put it that way, if it's something that we can use. A bit complicated.
Okay, there's another question. What percentage of rental income is calculated as borrowing capacity? For example, some places only count 60% of rental income towards the borrowing capacity.
Yeah, well, we actually have kind of what we call prestige property or non-prestige property. Usually, we actually count 80% of the rental income. But with some prestige area, say property like, I don't know what the prestige definition nowadays, but pretty much in the old days, it's 3.5 million. Nowadays, I think they changed it to, I think 5 million or more or 4.5 in New South Wales. They recently changed anyway. I mean, different banks have different criteria on it. For those kind of properties, the rental, we only count 60%. Or some other area like a risky area, for instance, some of the tourism area, we only count 60% of the rental as well.
And then just to add to that, I think a part of the question was how much of the income can be used towards borrowing capacity. So realistically, from a bank's point of view, we would like to see that your main source of income is coming from employment, whether it's self-employed or whether it's through PAYG. And then a portion of the income that we're using is going to come from rental income. Now, let's say, for example, if a customer has multiple investment properties and they've got a lot of rental income coming in, but no actual personal income, that is not something that we would generally consider, but it is something that we can propose to what we call the credit team for them to review, given that they've got a lot of experience in buying investment properties, and their only source of income is coming from rental. We could look at an override for it, but it's not a straightforward approach. More or less, if your income coming from rent is less than 50% of your personal income, it should be a very straightforward transaction with the bank.
Sure. Thank you. Very lively discussion. So I think the take-home message is to just deal with someone who has experience, knows what they're doing, and can actually tailor a customized plan based on your circumstances. There's no right or wrong time to buy, just whether you're in the right position financially. So if there are no other questions, thank you very much to the Westpac team. I might wrap it up here. For members, this is actually a recorded presentation, so we will upload it to the YouTube web